Have you ever thought, man, I really wish I would have bought a home back in the 2020s or earlier when interest rates were a lot lower? Well, I got a solution for you, and it's not a time machine. It's called an assumable mortgage. You get to assume or take over the seller's mortgage, which includes their interest rate. Now, you're probably thinking, hold up, there's got to be a catch. Why have I not heard about this before? Well, there are two big things. One, it doesn't work on all mortgages, and we'll talk about that in this week's episode. And two, you can assume the seller's mortgage and therefore the mortgage balance, but they're not selling you their home for the balance, they're selling you the home for what it is worth. So therefore there's a delta between the mortgage balance and the sales price. So what happens there? We'll break that down in this week's episode. If it's your first time hearing the sound of my voice, my name is David. I have a background in mortgage underwriting as an underwriter, mortgage lending as a lender, and as a realtor. So yes, that is the entire home buying process. I've also purchased multiple homes myself, but most importantly, I've helped hundreds of people just like you buy their first home in real life. I don't just talk about it on the internet. Let's go get those keys. Welcome back to House Rich, the first time homebuyer show where we provide you actionable steps in layman terms to buy your first home. Let's get right into the assumable mortgage. So the assumable mortgage does not work on conventional loans. Conventional loans are the most popular loan type out there. About 82% of loans are conventional. So that's probably why you don't hear about it on every single property out there. First and foremost, when you're assuming a mortgage, the seller's lender has to be on board because you can only go through the seller's lender. Now let's assume they're all on board. They should be. Let's talk about an FHA loan. The seller and the borrower have to meet the FHA guidelines. The seller has to be in the property for at least a year and in the property living there as their primary residence. You as the buyer need to be using it as your primary residence, and you need to meet the basic guidelines such as if you have a 500 to 579 credit score, 10% down, 580 and above, 3.5% down. You have to meet the debt to income ratio requirements as well. Now for a VA loan, believe it or not, you do not have to be a veteran to assume a VA loan. But it's actually looked at kind of negatively from the seller standpoint because there's something called a VA entitlement, which allows the veteran to put down 0% on a loan. If you are not a veteran, you actually take the seller's VA entitlement when you assume the mortgage. So just kind of FYI, they may look at that as a negative from the seller's standpoint. And also, the lender most likely have to go through the regional VA loan center, which can tack a little bit of time into the loan process. But you guys are under contract. You've talked about this, so no one should be super worried about the added days to the timeline. But here's one caveat. If the seller purchased the home prior to 1988, there's like this weird guideline that says that you actually don't have to go through the regional loan center at all. You actually don't have to go through the lender as well to assume the seller's mortgage. However, you're going to want to do that, or the seller is going to want you to do that because you actually, or the seller is still actually responsible from a credit standpoint for the mortgage. So like if you assume their mortgage in that scenario, it's called like a freely assumable mortgage, and you miss a payment, it actually falls into the seller's credit, not yours. Next, let's talk about USDA loans. The biggest requirement for a USDA loan is it has to be in a USDA zoned area, which if they have a USDA loan, the property is in a USDA zoned area. And once again, USDA is 0% down. You have to meet the same USDA requirements, just like you have to meet the FHA requirements for that loan as well. You're probably thinking, man, how do I find these assumable mortgages? Well, talk to a realtor. Because here's the thing, if realtors have a home with an assumable mortgage, that is a huge bonus. So they're going to advertise these assumable mortgage. There's like email lists and email blasts that realtors are on advertising that. So your realtor most likely should be aware of these assumable mortgages in your market. Also, you can go just to like realtor.com or zillow.com and search the word assumable in like the advanced search bar, and those will pop up as well because the seller's realtors will definitely put that in the description of the home. Also look at pre-foreclosures as well because sometimes there's an opportunity for you to assume the seller's mortgage instead of them going into foreclosure, which could ruin their credit. So that's another opportunity for you to find those mortgages. Also, another benefit of this from a buyer standpoint is the appraisal is not needed as well. So it helps you save a little bit on the closing costs. Now, last but not least, as I talked about, the mortgage balance and the sales price are not the same thing. So let's say somebody bought a home for $300,000 back in 2020. That home may be worth 350, 375. Let's say 350, and somehow they've not paid down the mortgage to make the math easy. Well, there's a $50,000 delta between the mortgage balance and the value of the home. You as the buyer are getting a huge benefit by getting their super low rate. So they're definitely not going just to give up the $50,000 in equity too. Well, you the buyer have to figure out how to make up that $50,000. Maybe you got to come out of pocket $50,000. If you got $50,000 sitting on the sideline, big shout out to you for your great budgeting capacity or income earning capacity. Or another scenario is you may have to take out like a second mortgage or something in order to make up that $50,000 delta, because that $50,000 is due on the sale of the home. I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas? No worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets love. There goes your breakdown for the Assumable Mortgage. But here are a couple other ways to get a lower rate that I've talked about in previous episodes. One is the 2-1 buy down. It is a temporary buy down the first 2 years paid for by the seller in order to lower your interest rate. How it works real quickly is, let's say the market rate is 7.5%. You do a 2-1 buy down. Year 1, your interest rate is 5.5. Year 2, it is 6.5. And then year 3, it goes back to the market rate. You can also use a seller credit or money out of your pocket in order to just permanently buy down the interest rate. And then the last one is also just have good credit, right? Because you see all these things where it's like, hey, you know, the average rate right now is 7.5%. Well, that's the average. So people with on the top of the credit totem pole that are getting like, 7% rates or the high 6% rates as well. So there we go. But as always, buy land. Rumor has it they're not making any more of it.